Well, good afternoon, everyone, and thank you so much for joining me again. For those of you who don't know me, my name is Kate Clarke, and I'm a practice accountant turned headhunter. And through Artemis Clarke, we work with scaling SMEs to recruit senior finance professionals and to support business owners with their financial strategy. We started running these webinars almost a year ago now, actually, because time and time again we see business owners who don't have that financial background feeling sort of a little bit unsure about their numbers. And when you don't really understand what your accounts are saying, it's really hard to make good decisions and potentially get the funding that you need. So today I'm going to simplify things for you. And we're going to cover three main things. So first of all, we're going to cover the financial statements and what they actually mean. Secondly, we're going to look at some common mistakes that can trip up business owners, which includes discounting, pricing, and margins. And then finally, we're going to look at what banks and investors actually look for, specifically talking about EBITDA, which is a term you may have heard, and how you can use those same insights to run your business more effectively. And as we go through, I'd love for you to think about your own business. Which of these points ring true for you, and where might you need to dig deeper? And if you've got any questions, then please do just put them in the chat or drop me an email afterwards. You can send an email to inquiries@artemisclarke.co.uk, and we'll have that at the end as well. So without further ado, let's talk about the financial statements. So excuse me, there are three main financial statements that large companies have to prepare and submit to Companies House. I say large because there are exemptions for smaller businesses, but all businesses still have to submit their balance sheet to Companies House. I can talk about all three, even if you do have exemptions, because it is useful to understand what they are and how they interrelate. Now, in accountancy, there's a lot of terminology that I think is there to confuse the average business owner. It confuses me sometimes, to be fair. So, for example, I've mentioned financial statements. They could also be called your accounts, but you could prepare management accounts, and they're also called accounts. So when there's sort of duplicate names for things, or the same thing different things have the same name, then I'll try and point that out to you. So yeah, so in this particular instance, at this point in time, we're talking about your financial statements, which are the ones that need to be submitted to Companies House. Management accounts are for internal management information. So the three accounts are basically your income statement, which confusingly is also called the profit and loss. The second one is your statement of financial position, which is also called the balance sheet. And then you have your third one is your cash flow statement, which is actually different from your cash flow forecast, which I'll come on to talk about later on. But they're the three main statements. And I'm going to use profit and loss for the profit and loss account rather than income statement, and then the balance sheet for the statement of financial position, because I still feel that they're used more commonly. So in terms of the profit and loss account, it's effectively a scoreboard to tell you how your business is doing in terms of its profitability, as the name suggests. So how much came in terms of sales, how much went out in terms of costs, or what you anticipate to go out in terms of costs, and what's left is the profit that you have made. Now, typically these reports are prepared on a sort of a monthly, quarterly or yearly basis. When they're submitted to Companies House, it's typically on an annual basis. But the key thing to realise here is that profit is not the same as cash. So you might make a big profit on paper, but if your customers haven't paid you yet, your bank account can still look very bare. I guess it's a bit like having a pay slip that says that you've earned £5,000 this month, but if your employer doesn't actually pay you until next month, then you're going to have trouble in terms of paying the bills. The second financial statement, as I mentioned, is the balance sheet or statement of financial position. This one, I think, quite often gets overlooked by business owners. I think it's a little bit intimidating, but if you think of it in terms of being a financial snapshot, and we'll talk about it in terms of personal expenditure, it makes it a lot more straightforward, I feel. So it's basically a snapshot of what you own and what you owe at a single point in time. So the P&L was over a period of time, your performance over a period of time, whereas your balance sheet is just looking at a single point in time. So if you wrote out your own personal balance sheet, you would list out your house, your car, your savings, maybe your pensions. That's all your assets. Then you'd need to list out, let's say, your mortgage, if you've got a mortgage on your house, your car loan, if you've got a car loan, credit cards, overdraft potentially. These are all your liabilities. And basically the difference between the assets and the liabilities is your net worth. So in business, that difference is effectively called equity. So going back to the business analogy, in a company, your balance sheet will show things that it owns. So say that cash, your stock, money that is owed by customers, your buildings, your equipment. These are all things that you own or the business owns. And then things that it owes to other people would be things like bank loans, supplier bills, tax due to be paid. And again, the difference between the assets, what they own, what the business owns, and its liabilities, what it owes, is the shareholders' funds or the equity in that business. And I think once you sit through that lens, it makes it far less scary. So just going on with the analogy of your house, if you had a house worth 500,000 and you've got a mortgage on it, let's say for 300,000, then the net equity, the equity that you have in that house, which I think people understand, is 200,000. And the same principle applies in business, but with more assets and more liabilities being netted off. Obviously, if you've got a situation where your assets exceed your liabilities, then that's good. You've got positive equity. But if you've, for example, bought a house and then it say devalues, then you're in that awful situation of negative equity. And the same can happen in a business. If you keep on making losses, or if you buy an investment and that gets devalued, then you can be in a situation where you've actually got negative equity or negative retained earnings. Now, I did a whole webinar on the balance sheet last year. So I'm not going to go into like loads of details on this. I did it with one of our fractional finance directors, Ramsey. So I'm not going to go into loads of detail, but what I do want to share with you is an example of a balance sheet that is in quite a lot of stress. So let me just bring up my screen. So you can see in this particular example, we've got a situation where you've got net current liabilities. So that means that your liabilities that will fall due within 1 year, so likely you're going to have to pay them in the near future, that exceeds the amount of assets that you've got that will come in the next year, normally your trade debtors and cash. So you can see that, you're already going to be in quite a tricky position and run out of cash. And then also you can see on this balance sheet, if you look at the bottom there, you're in a negative retained earnings position. So that basically means that over time losses have been incurred and you haven't got enough cash that's come in to put that into a positive position. So that's a bit like the example with the house being in a negative equity position if it's gone down in value when you've got a mortgage against it. So those two things basically demonstrate that this company is in quite a lot of financial distress. And so if you were looking to work with a new customer or a new supplier and you saw a balance sheet like that, then I would be asking some questions about how how they might continue as a going concern. You'd need to be happy that they were going to be getting some sort of funding to keep them going. So in speaking about funding, that kind of brings us nicely on to sort of cash flow. Obviously, if you get money in, then that's going to be positive in terms of your cash flow. But essentially, your cash flow is the lifeblood of your business. And it really doesn't matter how profitable you are on paper. If the cash isn't there when you need it to pay bills, you've got a serious problem because you technically become insolvent. And if you become insolvent, then your creditors have the power to close you down as a business. So it is a serious problem. So going back to sort of your own personal expenditure and your own household budget, if you might technically earn £5,000 a month, fantastic. But if your bills all fall due the week before your payday and you haven't got any reserves, then you're gonna be in trouble. You're gonna constantly feel broke because you're not gonna have the cash in the bank to be able to pay them. So businesses are exactly the same, and you have to make sure that you're monitoring that cash flow, especially as your business grows and money gets tied up in working capital. And that's why investors and lenders are so obsessed with cash flow, and they want to know not just are you profitable, but do you actually have the money in the bank to meet your obligations? The cash flow statement is very much like the profit and loss account in terms of it shows the cash flows of the company over a period of time. So it's not a snapshot like your balance sheet. And that time frame will be the same as your profit and loss in terms of the reporting when they're prepared, when those statements are prepared together. So if your profit and loss account is for the year, then your cash flow statement will also be for the year. But like the P&L, it's very much a backwards looking report. And the accounting legislation is quite tight. It dictates the categories for each transaction that the business will make. So basically every item that goes through the bank account as a cash transaction needs to be classified for small business into one of three categories, which are operating activities, financing activities, and investing activities. Now, the majority of transaction will obviously go into operating activities, but let's say you have a loan and you're making interest payments, then that will feature in the financing activities line. And if you've invested in fixed assets, let's say, then or you've bought another business, then that expenditure will feature in the investing activities line. Larger companies have to disclose a lot more in terms of their cash flow statements, but I'm not going to go into the detail of that in this webinar. You'll all fall asleep. But for small businesses, it is just those three classifications. And although investors and bankers will very much look at the cash flow statement to get a feel for where money is being spent, I would say as a business owner, the cash flow statement is not as valuable as your cash flow forecast, which is something I mentioned earlier, and we'll talk about in a bit. I'll give you an example of that towards the end. The final point on the financial statements is really how these interrelate. So hopefully you've kind of got a flavour of what they say. But for example, the profit and loss account will say we made a sale, but the balance sheet at that point in time, assuming that it was on credit to a customer, it will say, but the customer still owes us money. So that's an asset from your trade debtors. And then the cash flow statement will say, but there's nothing to report here because the bank balance hasn't moved yet. We haven't had that money coming in. So you can kind of see how it sort of flows through the three different statements. So they're very, well, I think they're very interesting being an accountant, but hopefully that kind of shows you how they interrelate. And it's really useful to be able to read that. It will tell you a lot about the financial health of the business. So I promised to talk about sort of common pitfalls that business owners, well, and other people can quite often make. And one of them is very much the sort of the turnover versus profit situation. So yeah, classic mistake is just focusing on sales. I remember when we did the Goldman Sachs, when I went on the Goldman Sachs 10K SB program, which if you're hearing this for the first time, Google it. It's an amazing growth program. But I remember them making this real point when they got us to talk about our projections. It wasn't just the turnover that we should be looking at. It's actually thinking about all the costs involved and the overall profitability of the business that is really important, and that's what investors and bankers, they will care about is that bottom line more so than the top line. A classic example of this was when I back in my corporate life, I worked in a facilities management business, and I always remember that business did a lot of acquisitions of sort of smaller entities, and then basically had an earn-out model. But I remember they did an acquisition of a very profitable technical business, so it had high margins, high gross margin, high net margin. And I remember the founder of that being quite irritated by some of the other MDs of other subsidiary businesses that gloated about how big their turnover was, and he was his bottom line was so much healthier because his margins were so much better, and ultimately his business would be much more valuable. But it was just kind of frustrating that these other MDs kind of felt that they were, I guess, superior because they could quote much bigger turnover figures. So but I'm sure that the founder with the higher profitable business ended up doing significantly better because ultimately his business was far more valuable, in terms of the bottom line. So the first lesson, it's not just turnover. Turnover is vanity, profit is sanity. It is very much the net profit that counts. And it's not necessarily just the net profit in terms of pounds, it's the percentage margin as well. So those businesses that had like the high turnover, their net profit margins were 3-4%, whereas the technical business, the net profit there I think was sort of 20-25% profit margin, so much bigger. So that's one of the first things that can often catch people out is that focus on turnover versus profitability. Another really common thing that will catch business owners out is the impact of discounting or even giving commission to salespeople. So it feels tempting to drop your price to win more business. But I'll show you another example in a minute. That the maths don't lie. It has such a big impact. So let me just share my screen again. So here we've got an example of a business where before the discount you've got turnover of 100k, gross profit 70k, net profit 30k, and we then are going to give a discount of 30%. So your turnover now is now 70. Your cost of sales remains the same. So your gross profit now has been massively slashed. It's now 40,000 rather than 70,000. But because you've got overheads of 40,000 in this particular example, you've now got no profit at all. And that's quite a big a big deal. And you kind of think, okay, well, that's fine because I'm going to get more business. It's not a problem. I will soon get the net profit up. But if you look at the next slide, this shows you that actually to get the same net profit margin as you had before doing the discount, you would actually need to have a whopping 75% increase in your sales volume to get the same profit as you had before, which is quite shocking really when you look at it like that. Now the good news is that the flip side is even more powerful. So if you have a situation, let's take another example. We've got an example here where this is a slightly lower margin business. So we've got actually cost of sales of 70,000. So our gross profit is 30,000 and our net profit is 10,000 after taking overheads of 20. In this example, we have increased the price by 10% and we have then decreased the volume by 25%. So you can afford to sell 25%. You can lose a quarter of your customers and still make the same profit if you have the same margins as this business. It's slightly different if your margins are different. But yeah, that to me is quite shocking. You kind of think, okay, well, you increase it by 10%. If I then have a loss of 10% of customers, then I'll probably be worse off. But it doesn't actually work like that. So in this example here, put your prices up by 10%, you can actually afford to lose a quarter of your customers and still make the same net profit, being that 10,000. So I guess if you think about your personal life, let's say your broadband bill going from £40 a month to £44, you probably wouldn't switch provider just for the sake of that, even if you did notice a little increase. And I guess in business, customers often react in the same way. Far fewer customers will leave you probably than you fear. And actually the ones that leave you are invariably the ones that are quite a pain to service. So yeah, it's definitely worth looking at your pricing. And it also makes sense to do it regularly, like so try and incorporate it as like an annual thing, rather than leaving it for 5 years and then suddenly having to do a massive price increase, because obviously your customers will notice it much more than, if you're just doing it regularly. So another common mistake is lumping all of your sales into one bucket, which can quite easily happen if you grow as a business. You start offering different service lines and you don't always think, oh, it's worth setting up a different account code to track this, etc. So taking a look at this slide here, we've got a very simple chart of accounts. So we've got, by all accounts, quite a profitable looking business, 40% gross profit margin. Haven't gone down into the net profit margin because we're just focusing on gross here. But just on the face of it, you could go, okay, well that's not doing too badly. But in this example, we've got a solar energy company which started off doing installations as its first thing, and then over time it started offering audits and consultancy. But this P&L doesn't split that out between the different activities that it does. So it's very difficult to make any business decision based on which bit of the business is doing well. So in this sort of scenario, it makes sense to actually break it down into those 3 different service lines. So if you have a look here, once you then do that, you can see, gosh, well, actually, the audit side of the business, that is super profitable. Whereas, the And gold consultancy is, pretty much as you'd expect for consultancy, but the solar installation bit is actually, almost sucking the profitability from the business. So by splitting it out, you can sort of see, okay, well, what can we do to try and increase the audits that we do, or is there anything that we can do to make the solar installations more efficient? Can we cut costs anywhere? How can we make that business more profitable? So by doing that, you're no longer flying blind. You've got the visibility, and then that will help with your decision making. So another thing that can often catch out businesses, or business owners, I should say, is the whole matching concept. So this is a fundamental concept in accounting. I won't bore you with the details, but essentially it's about matching your costs with your sales. And the reason why it's so important is because you get a picture of actually that activity and how it's performed. So a lot of businesses, let's say a website design business, they often will take deposits up front. So you get your deposit in to do whatever service you're going to offer. But then actually the costs relating to performing that service quite often will happen in another month. And if you don't match your income with your costs, then you'll get really good profits in the first month and then really poor performance in the next month. So just having a look at this, we've got an example here. So without the deferral of revenue, you'll see that you've got £1,000 that came in month one. That whole amount gets recognised in the profit and loss account. But you haven't got any costs because no one's done any work on this project at this point in time. So it looks like, wow, I've done really well. I've got a profit of £1,000. But then in the month when you actually do the work, well, then you've got all the costs coming through, but you've got no revenue. So it's really, that's kind of almost meaningless. So you kind of then have to end up adding it all up to then work out how you've done overall. So it's much better if you can actually match them on a monthly basis so that you're not then having to go back and sort of rework out, each individual project. So obviously with the matching concept applied, you would then see the profit and loss account. You would see it hit in month two, which is the month where the work is done, where you want to recognise that income, and that's when your costs are incurred. So at the start of the webinar, I did promise that I would explain EBITDA, which I'm sure is an acronym that you've heard flying about, but isn't often explained that well. So I've got a lovely little waterfall diagram that, gone too far, waterfall chart that shows how you get from your net profit to your EBITDA. So you basically will take your net profit and then you add back, so you take out the taxes that have been deducted to get there. You add back any interest that has been deducted to get there, and you add back depreciation and amortization. So then that gives you your EBITDA figure. And in plain English, what it's doing is that it's stripping out the financing, the tax, and the accounting adjustments to show how your business is actually performing operationally. And this matters because when you buy or when you're looking to sell your business or you're looking to raise money, valuations are normally done on a multiple of EBITDA because it's telling the investor or it's telling the bank this is the operational effectiveness of the business. Something really useful to understand here as well, if you are looking to sell your business, is that if, for example, you are only paying yourself minimum £12,000 and the rest is going out through dividends, EBITDA doesn't take dividends into account. So an adjustment will be made for that. So let's say that the investors decide that a fair salary for an MD of the business is 150,000, and you're only taking out 12,000, then they will deduct the difference, so 138,000, from your EBITDA as calculated there, to get to an ongoing EBITDA situation. So similarly, if you've got operations, so let's say that you had a certain service line, so going back to the solar panel business, if you then decided to close that business down because it wasn't profitable, then whatever profit that it did contribute to your EBITDA in the year would get removed, because that isn't an ongoing activity of the business. On a more positive note, well, not say positive for people that are made redundant, but let's say you had one-off costs relating to redundancy, then those get stripped out, because you're looking at that sort of ongoing operational profitability of the business. So there will be various adjustments that happen to your EBITDA figure before any sort of valuation gets performed on it. And finally, your investors or the banks will also want to look at a decent set of management accounts. Now, this can quite often catch business owners out because they don't realise that actually, when you come to sell or potentially get investment, they will want to see the history of the business financially for the last, probably 3 years. And that means actually having decent management accounts that show how the business has performed. And those management accounts also then need to tie into your statutory account. So if you're not doing that on a regular basis, you'll probably have to get someone to come in and retrospectively do it. But it would be much simpler if you can actually get into the habit of, if you can't do it monthly, then try and do it quarterly, to get sort of a good set of quarterly management accounts to demonstrate how the business is doing. So when I say a good set, what do I mean by that? It's not just the profit and loss account on a company basis. It's the profit and loss account split by service line and compared with, hopefully you have a budget, and then also compared with last year. It's a balance sheet that actually reconciles that is compared with last year as well. A rolling cash flow forecast. So we've spoken about that cash flow statement being the backwards looking statutory report, but a rolling cash flow forecast is a forward looking picture of how your cash flow is going to be looking. I've got an example to show you in a minute on that. So especially if you're growing fast, it's really, really important to look at that. And then most importantly is a simple KPI dashboard with just a handful of numbers that really matter. So let me just quickly, so this is an example of a dashboard. So you can see like the cash balance forecast, which will be fed from the cash flow forecast that I'll show you in a minute. Looking at customer days, for example, if it's a service company, then looking at sort of utilization rates and monthly revenue. But for your business, you'll need to work out what the key drivers are and what you want to have on your dashboard. We did do a webinar on KPIs, sort of I think that was one of our first ones last year, so go back and have a look at that. But that's what you need to then work out, that you have as your sort of your warning light. A bit like with a car, you don't need to see the entire wiring diagram every time you drive, but you do need to see the speedometer, the fuel gauge, and a few warning lights. And if one of those lights flashes, then that's a signal that you need to then dig deeper. So good management accounts will give you the same clarity. You should be able to spot things quite quickly, and then you can dive into things if if there is more sort of concern to be looked at. So just to quickly show you, I'm not going to labour the point here, but this is just an example of a profit and loss account versus budget last year, etc., year to date and this month, split out. and you'd have the different service lines there as well, which I haven't split out on this particular one. This would just be for one particular service line. Then an example of your balance sheet, so you can see last year and then versus last year, so you can see the movement, etc. All reasonably straightforward. But this is the one that I really wanted to show you, the cash flow forecast, where your actuals are like weeks 1, 2, and 3, and then you can see that weeks 4, 5, etc. are the forecast, and so they're the ones like in purple here. But you can see actually that in red you've got a problem at week 4 and week 9, and you can see that really, it's shouting out at you from having that forecast, which you don't get from the cash flow statement, which is why this to me is like one of the most important things to have within your business, to make sure that you're not flying blind as you scale it. So I think that's enough death by PowerPoint. That's my call to action there, in terms of if you have any questions, then either put it in the LinkedIn comments. I'll get back to you there, or email me. But also, let me just stop sharing that. Also, last year we started offering a financial health check to business owners, which basically is kind of a deep dive over a couple of weeks, where you give us access to your accounting system, the reporting that you do, and we prepare a report which will give you bit of a traffic light system in terms of the risks that we see and where we feel that you're potentially exposed, and where sort of further work's required. So if you would like to discuss that with me further, or talk to any of our clients that have been through our financial health check, then just let me know by email inquiries@artemisclarke.co.uk. Yeah, it'd be great to hear from you. And if you have any feedback in terms of anything that I could have explained better, or there are other topics, if you want me to go through how to put a cash flow forecast together as a future webinar, then please let me know, because I'm always trying to find stuff that's of value to scaling business owners. So yeah, please just get in contact. But hopefully something there resonated with you, and I look forward to seeing you at another one. So thank you so much, and have a great rest of the day. Thank you. Bye.